Today, a week of critical signals. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. This week, we get a series of economic signals as several countries were delivering their latest figures. China's inflation figures actually already surprised on the high side on Monday, although they were still relatively modest at 1.5% year-on-year in March. But that still saw yields on China's 10-year government bonds fall below US Treasury yields for the first time in 12 years, which is significant. And later in the week, the US and the UK will be reporting their inflation numbers. The US is expected to report a pace of inflation in March to something like 8.4%. That's a 4-decade high. The conflict and its impact on supply chains, notably food, has not yet been figured into the CPI data, which was nonetheless already at 40-year highs. The probability of a US recession next year is now sitting at 40%. And the spotlight will also fall on the Reserve Bank of New Zealand, the Bank of Canada and the ECB and their interest rate decisions. And on Thursday, the economic calendar will start with Australia's employment numbers for March. The unemployment rate is believed to have dropped a bit from, say, 4% to 3.9%, and the participation rate is forecast to improve by a fraction, going from 66.4% to 66.5%. Whereas the employment change reading is expected to decline from the previous 77,000 to 40,000. And if the actual numbers show below their initial forecast, the Aussie dollar could certainly weaken slightly against some of its major counterparts. And in fact, the Aussie dollar has been weakening in recent days, and that trend well may continue. And of course, in the US, the results season will also power up, with JP Morgan reporting results on Wednesday, while Citigroup, Wells Fargo, Goldman Sachs and Morgan Stanley will report on Thursday. The euro rose against the dollar to snap a 7-day losing streak as the single currency rallied after French leader Emmanuel Macron beat far-right challenger Marine Le Pen in France's first round of presidential voting last Sunday. Volatility gripped French blue chips on the outlook of a tight Macron-Le Pen race in the final round of voting. French assets have underperformed as markets are uneasy about Le Pen's agenda for protectionism, tax cuts and nationalisation. The CAC 40 index was off 1.5% so far in April, and the Stoxx 600 gained about 0.4%. I don't expect the French equity market to rally until we have the second round. We expect a lot of volatility and range-bound trading, said Matthew Richier, head of equity strategy at Julius Baer. It is really a close call in the runoff. Now, the US dollar held just below almost 2-year highs against a basket of currencies and strengthened against the Japanese yen, up 0.88%, and versus the commodity currencies, the Canadian, Australian and New Zealand dollars. The yield on benchmark 10-year treasuries rose more than 7 basis points to 2.793%. That's the highest level since January 2019. US bond yields are on the rise as investors continue to digest the Fed's more hawkish position. As a result, the 10-year yield has pushed from 2.4% to 2.7% in the past week, Stifel said in the note. Yields have surged in anticipation of Fed rate hikes, which Dec Mullarkey, Managing Director of Investment Strategy and Asset Allocation at SLC Management, expects to be by 50 basis points at each of the Fed's next 3 policy meetings. The Fed is going to move aggressively and the market has appropriately priced it in, he said. They don't want it to be an issue in the midterms, he added, referring to elections in November that will determine whether Republicans can wrest control from President Joe Biden's Democrats in the US Senate and House of Representatives. They also do not want to be in the position where they don't have inflation under control. But if the recession risk rises, that's going to cause central banks around the world to aggressively reverse course of their tightening talk. And talk is the point, of course, which makes me ask if the Federal Reserve in particular is really trying to reduce inflation, or could it be that the goal is not to actually fight inflation, but to appear to fight inflation so that domestic politicians can survive an angry populace that ends up working for much longer hours but will be affording less? Anyhow, the Dow Jones Industrial Average slumped on Monday as investors abandoned tech in the wake of surging US Treasury yields a day ahead of that fresh inflation data. The Dow Jones Industrial Average slipped 1.2%, the S&P 500 fell 1.6%, and the Nasdaq fell 2.2%. Technology stocks snapped a 3-week winning streak last week, starting the week on the back foot as those Treasury yields continue to rack up gains on expectations of more aggressive policy from the Federal Reserve. Microsoft was down more than 3%. They led the decline in big tech after UBS estimated that Office 365, the tech giant's second biggest business, will likely see declining growth ahead as the boost from pandemic and work from home trends fade. Facebook, Apple, and Alphabet were all down more than 2%, and Twitter, meanwhile, bucked the broader trend after Tesla chief executive Elon Musk made a U-turn on the decision to join the social media's board, paving the way for Musk to buy more shares of Twitter. Joining the board of Twitter would have limited Musk to owning no more than 14.9% of the company. Semiconductor stocks also pressurized the broader tech sector as sentiment on chip makers was hurt after Baird downgraded Nvidia to neutral from outperform and cut its price target on the stock to $225 from $360, sending its shares down more than 5%. Baird flagged order cancellations for Nvidia's consumer GPUs and said the upcoming fork for cryptocurrency Ethereum could further dent demand. Financials, mostly banks, relatively outperformed the broader market, being down just 0.2%, and that was boosted by rising yields ahead of the start of the quarterly earnings season. Energy stocks were also a big drag on the broader market, even as oil prices were pressurized by worries about the impact on demand from lockdowns in China. Occidental Petroleum, Diamondback Energy, and ConocoPhillips were among the biggest decliners in the sector. In other news, Sony detailed plans to invest an additional $1 billion in Epic Games in the deal that further expands its collaboration with the video game maker. Oil prices fell about 4% on Monday, with Brent crude tumbling below $100 US a barrel on worries that the COVID-19 pandemic will cut demand in China and as International Energy Agency countries plan to release record volumes of oil from strategic stocks. The WTI closed at its lowest since February 25th. That was the day after Russian forces invaded Ukraine, an action, of course, Moscow called the special military operation. Brent futures fell $4.30 or 4.2% to settle at $98.48, while WTI crude fell $3.97 or 4% to settle at $94.29. That's the lowest close for Brent since March the 16th. Fuel consumption in China, the world's biggest oil importer, has stalled with COVID-19 lockdowns in Shanghai. Analysts at Eraser Group Consultancy said Shanghai, China's financial center, started easing lockdowns in some areas on Monday, despite reporting a record of more than 25,000 new COVID-19 infections. Even when the restrictions in Shanghai are lifted, China's zero COVID policies will likely remain a drag on demand, Eraser Group said, noting Shanghai's lockdowns likely reduced China's overall oil consumption by up to 1.3 million barrels per day. To help offset a shortfall in Russian crude after Moscow was hit with sanctions, IEA member nations, including the United States, will release 240 million barrels of oil over the next 6 months. The release of Strategic Petroleum Reserve SPR volumes equals 1.3 million barrels per day over the next 6 months, enough to offset a shortfall of 1 million barrels per day of Russian oil supply, according to analysts at JP Morgan. The SPR release will be the largest of all time and has already broken the back of the WTI price curve, said Robert Yorger, Executive Director of Energy Futures at Mizuho, noting the spreads were sliding towards contango. Contango signals an oversupplied market. It is when prices for later dated months are higher than the front months. In contrast, when concerns about supply shortages were high in early March, the WTI curve was in what Jaeger called super backwardation, with each month at least $1 a barrel below the prior month through to November 2023. Adding pressure to crude prices, the US dollar was on track to strengthen for an 8th straight day against a basket of other currencies. A stronger dollar makes oil more expensive for holders of other currencies. And in a move that could tighten global oil supplies, the European Union executive is drafting proposals for an embargo of Russian oil, although there is still no agreement to ban Russian crude. The Organisation of Petroleum Exporting Countries, or OPEC, told the EU that sanctions on Russia could create one of the worst ever oil supply shocks, and it would be impossible to replace those volumes. OPEC signalled it would not pump more oil. We could potentially see the loss of more than 7 million barrels per day of Russian oil and other liquid exports resulting from current and future sanctions or other voluntary actions, OPEC Secretary General Mohammed Barkindo said. Considering the current demand outlook, it would be nearly impossible to replace a loss in volumes of this magnitude. But the European Union reiterated its call in the meeting for oil-producing countries to look at whether they could increase deliveries to help cool soaring oil prices. And EU representatives also pointed out that OPEC has a responsibility to ensure balanced oil markets. So far, OPEC has resisted calls by the United States and the International Energy Agency to pump more crude to cool prices, which reached a 14-year peak last month. And in the meeting with OPEC, the EU said OPEC could provide more production from its spare capacity. Still, Barkindo said the current highly volatile market was a result of non-fundamental factors outside OPEC's control, in a signal the group would not pump more. OPEC Plus, which consists of OPEC and other producers, including Russia, will raise output by around 432,000 barrels per day in May as part of a gradual unwinding of output cuts made during the worst of the COVID-19 pandemic. Now, Russian oil, of course, has been excluded from EU sanctions so far, but after the 27-country bloc agreed last week to sanction Russian coal, its first to target energy supplies, some senior EU officials said oil would be next. And it's worth noting that Australia, Canada and the United States, who are less reliant on Russian supply than Europe, have already banned Russian oil purchases. In fact, though, EU countries are split over whether to follow suit, given their higher dependency and the potential for the move to push up already high energy prices in Europe. The EU expects its oil use to decrease by 30% by 2030 from 2015 levels under its planned policies to fight climate change, though in the short term an embargo would trigger a dash to replace Russian oil with alternative supplies. And US President Joe Biden and Indian Prime Minister Narendra Modi held talks on Monday as Washington pushed its Asian ally to support its response to Russia's invasion. India, the world's third biggest oil importer, has actually increased purchases of Russian crude in recent months because Moscow has been forced to sell its oil at a steep discount since invading Ukraine. Fuel demand in India rose to a 3-year high in March, with petrol sales hitting an all-time peak. And finally, US gold futures settled up 0.1% at $1,948, while Bitcoin fell 5.66% to $39,749. So the volatility continues, and really there are very few safe havens out there at the moment. So many uncertainties. So the data this week will help to mark the card in terms of what may happen next. But I want to come back to this point. There is a big difference between talking about dealing with inflation and actually doing so. And until we see action taken by central banks, it's all talk. And that, of course, is just the point. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.